So today we're going to take a look at Foot Locker stock, which was a really talked about stock last week because the stock dropped 30% after they reported earnings, which were not liked by Wall Street. And a few people were thinking, is this an opportunity or is this stock deserving to be dropping 30% at the moment? So is Foot Locker a stock to buy? Let's take a look. And if you haven't already, make sure you join the Patreon. Link is in the description. It's only £5 a month. You get to see 2 exclusive videos a week from me on there. Actually, this week there's going to be 3 exclusive videos. I'm about to drop the US portfolio review. And also you get to see this video here where I have just sold a stock and bought a brand new stock into the portfolio. And if you do want some free shares from Trading 212, that's a broker I use. Join through the link in the description. You get a free share worth up to £100. But let's get on to Foot Locker stock. This is why we're here. So Foot Locker, ticker symbol FL. It's currently $17. And if you look on the stock chart, you can see here it's been a bit of a tough ride if you have been a Foot Locker shareholder. The stock peaked in 2021. Add it to the list of stocks that peaked in 2021. And from that time frame, the stock is down 72%. But even if you go to the recent 52-week highs, you can see here the stock did really peak around about 2023, at the start of 2023, and since then it's down 62%. And you can see here there was actually an initial drop around their Q1 update, and that caused a major drop in the share price. And then once again, that's been followed up by a major drop in the Q2 update, which we're going to look at in a second. Now you see here it is 11 times earnings, but this will update in the next few days because it is no longer going to be 11 times earnings because they currently did put an unprofitable quarter in. And if you look here, it does say dividend yield 9.3%. Now, unfortunately, most of the time people have got into Foot Locker in the last few years is because of this 9% dividend yield, which you're looking at going, well, I just need to, if the share price does okay, I just need to collect that 9% a year, and I'm probably going to be somewhere around about where the S&P returns. Unfortunately, they have cancelled that dividend, which we're going to take a look at in a second. And that, I think, is what's really affected the share price. That a lot of those dividend investors have suddenly gone, okay, I'm not getting my dividend anymore, I might as well sell my shares. And that's one of the big risks. That's sometimes one of the biggest risks when you get sucked into some of these stocks and you go, oh, it's a really high dividend yield, but there's also probably a risk there that the dividend may disappear or get cut. And that has unfortunately happened with Foot Locker because on the recent update, the financials were very poor, which we're about to show you. Now, obviously Foot Locker, sure most of you guys will know what Foot Locker is. Obviously, they are a high street retailer, but also with their online brand, as you can see here. And obviously, they're mostly known for selling shoes or trainers. They do have presence around the world, and they do have a couple of other different brands as well under that Foot Locker name. Now, looking at their earnings that actually caused their first drop, which was this drop here, that did not make good reading only 3 months ago. You can see here there was a big EPS, negative revenue, missed as well, and you can see here they actually lowered their guidance from where they were expecting previously. And one of the big issues that Foot Locker has been battling away with at the moment is Nike. So Nike were rumoured to move away from Foot Locker to try and focus on DTC, direct to consumer. So Nike went, rather than giving Foot Locker some of our shoes, we're going to take some of your inventory away and hopefully then people come to us and buy directly. We make more money from that, from doing direct to customer, and obviously that was a bit of an issue for Foot Locker. Now, Foot Locker is currently made up mostly of Nike products for their revenue. So you can see here, Nike products accounted for 70% of Foot Locker sales in 2021. And obviously the worry is if Nike does move away, this can cause a major impact on Foot Locker's numbers. Now, there has been suggestion that they have been trying to make up that relationship once again, but it does show you the pressure that if Nike were ever to snap their fingers and move away from Foot Locker, when it's 70% of your revenue, that is a major issue. And that's what I think a few people are worried about. And it does seem like in the recent earnings, there was that little bit of pullback from Nike in the sales, which did cause a little bit of problems. So we fast forward now to August of 23. So this is the 23rd, sorry. And this is the most recent drop that we've got. And when we look at the financials that have recently just come out, you can see here there has been no improvement from 3 months ago. The EPS was a miss. The revenue was down at negative 9%, missing by 20 million. And once again, they did cut their outlook again, back-to-back cuts. That is never good. Now you can see here, sales now is going to be down from 8 to 9% from the prior guidance, which doesn't look too bad. You can still see that comparable sales to be down as well, 9 to 10%. But this is where the big scary part came in. Non-GAAP EPS of $1.30 to $1.50 from prior guidance of $2 to $2.25. That is a major pullback in the EPS, which is the really worrying thing here. Now, I did dig through the financials and tried to pull out anything that kind of stood out to me. So you can see here that they said, Mary Dillon, President and CEO, said that our second quarter was broadly in line with our expectations despite the still tough consumer backdrop. Now, I was quite surprised because I like broadly, and I was looking at the earnings that they brought out and I was like, I don't know, you missed on EPS, you were down on revenue by 20 million, it was a little bit of a miss that you've got there. And then when we actually start digging through the financials in a second, I'll actually point this out. We said, however, we do see a softening trends in July and adjusting our 23 outlook to allow us for our best compete for price-sensitive consumers while still leaning into the strategic investments that drive our lace-up plan. Importantly, we are continuing to make progress on our inventory levels and look to best position the business for the upcoming holiday season in 2024. So they're basically saying we're also going to have to cut our prices now to get our sales, which obviously is hit that the profitability could be lower, the gross margins are going to be lower. Now, actually, when I digged into the recent quarter, you can see your gross margins declined by 460 basis points. So I was looking at this going, they're saying that they didn't see much of an impact in that quarter. But I'm like, but your gross margins declined because of increased promotional activity. So you're having to put more promotional activity out to sell your products. So you're saying that you didn't see weakness until July, but clearly what your earnings have just stated is completely the opposite. Your earnings said that you started seeing weakness because you had to decrease your gross margins for promotional. So I'm looking at the CEO here going, I think you're telling a little bit of fibs here. I think you're telling a couple of lies here because your recent earnings doesn't say that you only saw weakness in July. Your earnings said you saw weakness in Q2 and you had to start selling your products at promotional prices to get more sales, which isn't good. And the next thing is cash and equivalents. So you can look here, the cash went from 386 million down by half, down to 180 million. Now you can see here that you could argue that some of that did go into the inventories, as you can see here, but obviously with higher inventories and you're having a tough selling time, that means you're now going to have to sell that inventory down at lower prices. So they've not managed the inventories very well, and that also means they've got less cash at the moment. 180 million cash as well, which isn't good to see the cash go down by half. And obviously 180 million, when we look at the balance sheet, maybe could do with a little bit more cash than that. Now, that also led to the company having to suspend their dividend. So you can see here that they said that to increase balance sheet flexibility and support, obviously because the cash has massively gone down, and that then cost them on the dividend. Of longer term strategic priorities, the company is pausing its quarterly cash dividends beyond its recently improved payout on October 27 to holders of the record on October the 13th. So they're also having to pay the dividend out for the recent quarter, the upcoming quarter, but then they're going to have to pause it. Obviously, the reason why is because they haven't managed their inventories and they haven't managed their cash position that well as well. And that came from a point of view when you look at the second quarter and the year-to-date actual income, you can see here the net income or a loss. They went from profit last year, 95 million, into a loss of 5 million, which is not good as well to see from the company's financial point of view. Now, obviously, they said about the weakening consumer being one of the main issues of why the company was struggling. As you can see here, consumer softness, changing of vendor mix, which is probably the Nike situation, and the repositioning of Champ Sports. Now, when you do look at consumer sentiment, it was the lowest in 2022. We've seen a bit of recovery and we have seen a bit of a dip. And actually, when we do look at a lot of other consumer sentiments out here, for example, JD Sports, you can see here on their recent quarter that they said that the positive trends have continued in June through the group's business in the UK, Europe and Asia Pacific, although the growth from these regions is partly offset by the business in North America. So you can see it, a company very similar to Foot Locker, JD Sports, they said they saw softening in North America as well. So it does kind of line up that they are seeing weakening at the moment in this sort of market, and it is seen by other companies in this sector, which kind of gives you a little bit of reinsurance. But obviously, you know, you look at something like a JD Sports kind of example where they have organic sales of more than 15% growth. it's a big major difference between where JD Sports are and something like a Foot Locker are. So that's the other thing that you got to weigh up here. Now, the way that they are going to hopefully combat this is obviously to close down stores. You can see here the company opened 15 new stores, remodel allocated 60 stores, and close 108 stores. So they are trying to close down the stores that are not working out. Now, this works in both ways. A lot of people use this as positives, like, oh, they're closing down unprofitable stores. But what worries me is that obviously that means that the revenue is going to come down massively as well. And potentially could you see some of the profitability come down? It's store closures, people always look at them in a good way, but sometimes they can hurt. It's never a good sign to see a company closing down stores. That's a bit of an issue. So that's one way they're going to do it. Obviously, they've got the new CEO in. So if you've not seen, they did get Mary Dillon in, who we saw the statement from, which I thought she wasn't being too honest to the shareholders, as was what I showed earlier. But she came in as a CEO on the 25th of August, 2022. And people are hoping that she could turn around the company. You can see here that if you actually go onto a Wikipedia page, you can see here in June 2019, she was named one of Barron's best CEOs. Obviously, she did a pretty good job at Ultra Beauty, and people are hoping that she can run maybe JD Sports like how she did there. And obviously the big thing is that obviously people are hoping a little bit further down the line this consumer sentiment improves. Now obviously it could do. You got Christmas sales coming up potentially. That gives you maybe a bit of a lift, sorts the inventory issues out. But obviously the big issue is at the moment there's more and more fears about consumer tightening as interest rates go up. So it could work both ways with that one. I mean, ultimately what we're left with here is if we do look at the company is going to take a dive in the revenue. It is going to take a dive in the profitability. That is an issue. Now, financial health wise, they're actually not too bad. If you actually look at the financial health, they don't actually have too much debt. But this is where the problem does come in, where they only have 180 million cash and the debt is 440 million. So the debt is double what the current cash is at the moment. Now, obviously, you can say that they've got a physical assets of 3.2 billion. They've got inventory of 1.8 billion. So they should be okay from that point of view. But I don't know, obviously they're worrying about that cash. Cash can pay that dividend, and obviously that's what they've had to cancel. And obviously, you would hope that that dividend does come back, or the dividend coming back will probably attract shareholders back into the company. And you can see, the impact the dividend was having on the company. They were basically paying out, 101% of their earnings to shareholders, which is obviously one of the big issues. Now, obviously, a little bit of a positive note is in March, the CEO did buy some shares inside the company. She did buy these at $26 and also $39, so a lot higher than where the share price is right now. But sometimes it does show you all the time if a CEO is buying, it can go lower. We do say that an insider buying is a positive sign, but clearly she's bought some shares and obviously it's not worked out for the insider buying. So I guess overall, what's my opinion on Foot Locker and what could potentially the company do in the longer term? So if we have a look here, Foot Locker, ticker symbol FL, currently a 1.6 billion market cap company. Now I've put the revenue growth very, very low down. I've gone 1-3%. Now obviously I think that's pretty fair for Foot Locker. I even think that could be too optimistic because they keep closing down more and more stores. But as you can see, analysts are expecting the revenue growth to start coming back from 2024. So it's roughly what analysts are expecting, but even me, I personally think, I don't know if it's a bit too optimistic. Also worth pointing out when we look at profit margins are normally around 6%, 7%, as you can see here. Then they started to go a little bit choppy. Obviously that was a CV situation, so I won't take that. Obviously that's the kind of online boom and opening up boom back in, and now they're obviously down at 1.8%. So I've tried to go off Foot Locker's all kind of profit margins, which was 6-7%. And let's say that the margins do get impacted a little bit. So I've gone a little bit safer. So I've gone lower on the 3% range, 5% range. And if they get back to roughly where they were at, 7% there, I think that's quite fair. And I've put a multiple of 8 times earnings. Now, normally you guys know me, I put the average kind of valuation out there at 20. I don't think Foot Locker's going to go to 20 times earnings because it's a lower quality business. It has slower amounts of growth. It has lower profit margins. So when I do look at Foot Locker, I do think it'll trade at a lower valuation. But if we do look at history, you can see here, 16 times earnings, 11 times earnings, 9 times earnings, 11 times earnings. So it can trade at higher than what I've kind of put in here, but at that time, it looked a lot more of a solid business. The profitability was pretty stable. They were growing revenue in kind of a right way. Profit was slowly growing. it was a lot higher business 5 years ago than where it is right now. So that's a little bit of an issue there. So that's why I put it at a little bit of a lower valuation. I've got to have a little bit of risk to reward here, because obviously I think this is a bit of a risky investment. I think, you know, if you're buying this as a turnaround play, whereas previously it was a pretty solid kind of business, I would say. So if it does grow 1% a year and 3% profit margins, there's not much upside in this company here. If it does grow at 2%, but it does recover the profit margins 105%, if it does grow at 3% and gets back to 7% profit margins, that is where your bigger upside is. So I would say if you are confident that the new CEO can turn it around and get to, you know, back to a little bit of growth, the big thing is the rebound in profitability. The big thing you've got to be staring at is profitability with this business. I think that's where you're going to get your big returns, is getting that profitability up. Even if they don't grow revenue that much, I think the key thing is getting the profitability up. And if that happens, you could make good money on it. But as you can see here, if they don't, I don't think there's much upside here. So that's what it comes down to. Do you think the CEO could change it around and get them back up to profitability? Another thing that might be worth factoring in is obviously the dividend side of it. Obviously, if they do go back to paying a dividend, if they get to this profitability, you're probably going to be collecting a lovely, you know, let's say 5 to 10% dividend yield and get a good return on the share price. So that's where, if you are going to play this, you need to see the company get back to profitability. But for the lower side risk, if they can't get that, I don't see the upside. So for me, if I was going to buy this, I couldn't buy it right now, because I think that if they can never get back to the old levels of profitability, you're not going to make money on this investment, and there's not that kind of margin of safety there. So for me, if I'm going to buy this, if I was to buy Foot Locker, what I would have to see Foot Locker do is stay at around about $17, but if by the time we get through to the Christmas period, we start seeing no more lowering of the outlook, we start seeing that profitability coming back up, you know, we start seeing that profitability coming back on the company where they're actually making back into net income, and they're making good amounts of net income. And if that point of starts coming in, then you can justify going, I can see the profitability be rebounding now, and I'm still getting it at $17. I think that is where the opportunity would be for me to buy. So right now, my opinion on Foot Locker is that I can see why someone would want to buy it as a turnaround play, but in my opinion, the risk is just a little too high at the moment, because they have to show at least some improvements in the financials, and at the moment what we've had is back-to-back downgrades on the outlook. And for me personally, I would wait to see some improvement and then buy it, rather than being stuck with a bit of a stinker. So that's my opinion at the moment. So hope you enjoyed it anyway, guys. Let me know if you guys are a buyer or a seller of Foot Locker stock, and have a great weekend. See you later.